Hi everybody, it's Peter Schiff. It is Thursday, September 13th, 2012, and as far as I'm concerned, for the Federal Reserve, this is a date that will indeed live in infamy because this is the day that the Federal Reserve went all in on QE. Now, rather than reviving the economy, the Fed has just sealed its fate. In fact, I think it has driven the final nail in the coffin of the U.S. dollar, and with it, the entire U.S. economy. What Ben Bernanke has committed to do is supply an indefinite quantity of QE, of money printing. Ben Bernanke said that he will buy $40 billion worth of mortgage-backed securities monthly for an indefinite time period. He also promised to extend Operation Twist through the end of the year. In fact, as far as I'm concerned, this new policy may as well be called Operation Screw, because if you own dollars, you're screwed. If you own bonds, you're screwed. If you have a savings account, you're screwed. If you're an American, you're working for wages or salaries, you're collecting a paycheck in dollars, you're screwed. If you're hoping to retire on dollars, you're screwed. In fact, Ben Bernanke was asked a question during his press conference, and I think the press conference, which I'll talk about a little bit later, was maybe more interesting than the statement itself. But in answering a question, did he think it's fair to the savers that you're getting no interest? Because the Fed also promised to extend the 0% interest rates now into 2015, and he said, well, hey, it's too bad for savers, but look, it's good for the stock market. So in other words, if you've got your money in a bank, pull it out and buy stocks. Otherwise, you're going to be twisting in the wind as a result of Operation Screw. In addition to that, the Fed promised to keep interest rates low even after the economic recovery gained traction. In other words, it's tantamount to the Fed admitting that he realizes that the only reason the economy is going to accelerate or recover is because of the cheap money, and that the Fed knows that it can't take the cheap money away because it will simultaneously take the recovery away. So it is an open-ended commitment to keep interest rates at zero. However, it's not going to be able to keep that commitment. The Fed is saying that it's going to keep rates low until we get the job growth that we need. The fact of the matter is, the reason that we're not getting job growth now is because rates are too low. It's because of all the money that the Fed has already printed that the economy is so screwed up that it can't create jobs. And printing even more money is not going to solve the problem. Now, of course, the catalyst for this announcement was the horrific job numbers that we got last week, where not only did we create fewer than 100,000 jobs, but almost 4 times as many people left the labor force, meaning they threw in the towel. They were so discouraged that they quit looking for work, and they're no longer even in the labor force, as people who found jobs. In fact, the labor force participation rate is the lowest it's been since 1981, and if you just focus on males, it's the lowest it's been since 1948. So the Fed feels its back is in a corner, and it has to act. In fact, in that press conference that Ben Bernanke gave in response to a question, he basically said that the Fed has one tool, and that's purchasing financial assets to drive up asset prices, and the Fed is going to use that tool. Even if it doesn't work, the Fed's going to use it. In other words, the Fed has a hammer, and it's going to bang everything it sees. You know, even if it's not appropriate. I mean, maybe a hammer makes sense when you're trying to put a nail into a board. It doesn't make sense if you're walking through a china shop. But in other words, he's got this hammer, and he's going to swing it at everything in sight, and he thinks it's going to create jobs. The only thing it's going to create is inflation. And of course, the Fed denied that he was going to create inflation. Of course, even as the price of gold was surging over $30 an ounce in reaction to what the Fed said, silver up about $1.40, oil up $1 a barrel, the dollar index hitting new lows for the move. You got a new 52-week high in currencies, I think, like the Canadian dollar, the New Zealand dollar. Even the euro is now above 129, and I think headed much higher against the dollar. That's how weak the dollar is. It's even weaker than the euro. In fact, Ben Bernanke started off his press conference by saying that the Fed's printing money and buying bonds was not the same thing as the government spending money. Now, what is the difference, according to Ben Bernanke, between spending money and buying bonds? Well, Ben Bernanke said that since the Fed is not buying goods, that it doesn't count as spending. What do you mean? If you spend money on bonds, you're still spending. Just because you're not buying an actual product, you're buying a financial asset, you're still spending money. You're spending money to buy a financial asset. Now, the Fed also went on to say that, well, it's not really spending because whatever financial assets the Fed buys, it's going to turn around and sell back into the market when it unwinds the policy. Yeah, right. How is the Fed going to sell all these bonds? The Fed is the only buyer. Without the Fed, no one in their right mind is going to buy. Who's going to buy when the Fed wants to sell? Who's going to step in front of that freight train? Who's going to want to bid for mortgages when the Fed is trying to unload the mortgages that it owns? Nobody. In other words, the Fed is basically checked into the Roach Motel of monetary policy, right? It can check in, but it can't check out. It can expand its balance sheet, but it can never shrink it. So the Fed is spending money. It is spending it on financial assets. And in fact, the goal of the Fed is to make those assets rise in price. And this, this is the craziest part about it. And it's almost like it's a fantasy, or I'm in a dream, because it's impossible for me to actually believe that this is actually happening, that I'm actually hearing what I'm hearing or seeing what I'm seeing. But this is the plan that Ben Bernanke has. Ben Bernanke's plan to revive the U.S. economy and create jobs is to inflate another housing bubble. That's it. That's what the Fed's got. That's what it came up with. As if the last housing bubble worked out so well for the economy that the Fed wants an encore. Now, I'm not making this up. You can go check the internet, YouTube it yourself, Google it. But basically, this is what Ben Bernanke said. He is buying, the Fed is going to buy $40 billion worth of mortgage-backed securities every month. The goal of the Fed is to bring down interest rates. Ben Bernanke specifically said the reason he wants to bring down mortgage interest rates is because he wants home prices to go up. Now, why does Ben Bernanke want home prices to go up? He specifically mentioned two reasons. One, the wealth effect. Ben Bernanke said if we can get home prices to go up, homeowners will feel wealthier and they'll go out and spend more money. So he wants the wealth effect. He wants to create the illusion of wealth so that people will go out and buy stuff that they really can't afford, not because they earned the money, but because their house is appraising at a higher value. And of course, they can refinance, they can pull out equity, they can cash out money and go spend it. That's one reason. Number two, Ben Bernanke said, if we can get home prices to go up, people will realize that they can make money buying houses. And if home prices rise, more people will want to buy houses because they can make money. They can get rich buying houses, and so that will encourage more home buying, and as a result, we'll have more home building. If more people want to buy houses because they're going up in price, then we'll build more houses, and we can create an entire economy of the housing market, by the housing market, for the housing market. In fact, what the Federal Reserve wants to create is a super housing bubble. I mean, I kid you not, this is their plan. This is all they can come up with. And think about it. In the last housing bubble, it was the government that was guaranteeing the mortgages, but you still had the private sector owning a lot of the mortgages, although with government guarantees. See, now they're going one up. Not only is the government guaranteeing the mortgages, but the government is owning the mortgages. Basically, our new monetary policy, our new policy for economic revival, is for the Federal Reserve to print money and loan it to Americans at ultra low rates so they can go out and buy houses. And in the process, push up housing prices so we can all go on a consumption binge and spend all sorts of borrowed money on imported products, and somehow all of this is going to create employment, and it's not going to end in complete disaster, just like the last time the Fed tried to create a housing bubble to stimulate the economy. Now, talk about insanity, right? Talking about doing the same thing over again and expecting a different result. How can Ben Bernanke, with the memories of the last housing bubble and debacle and financial crisis fresh in his mind, how can he think that the solution to the problem is to try to recreate the very conditions that created the problem? How is another housing bubble going to solve anything? Now, one thing maybe Ben Bernanke hasn't figured out yet. It ain't going to work. No matter how much he tries, no matter how much air he blows into that housing market, he is not going to reflate that bubble. There are simply too many holes in it, and there is no precedent for reflating a busted bubble. More likely, all that cheap money is going to go someplace else. Where is it going to go? Well, if you look at what happened today, 30-year bond prices went down and interest rates went up. In other words, the bond market stuffed it right back in the Fed's face. Because I think the bond traders are waking up, the bond vigilantes maybe are coming out of their coma, and they're realizing that the worst thing for the bond market is for the Fed to print money and buy bonds. Because when they print money, they drive down the value of the currency that the bonds are denominated in. What went up? Gold, up over $30. Silver, as I said, the dollar tanked. So where is all this money going to go? Commodities. It's going to go to gold. It's going to go to silver. It's going to go into oil. It's going to go into agriculture. It is not going to make the economy better. It's going to make the economy worse. It's not going to create jobs, but what it is going to create is a higher cost of living for everybody, whether you have a job or whether you're unemployed. And believe me, if people are spending more money on food and more money on energy, they're not going to have any extra money left over for discretionary spending. None of this is going to work. But the amazing thing is people are looking at Ben Bernanke and analyzing what the guy has to say, taking him seriously. Can't anybody think? Doesn't anybody remember what happened just a few years ago? I mean, how can he not be laughed out of town? I mean, during that press conference, I mean, how come people aren't just shocked? How come they're not just saying, say what? Are you kidding me? How can this be your plan? How can reinflating a housing bubble be all that you got? I mean, how long did it take you to come up with this idea? How many brains at the Federal Reserve? Apparently, there was only one guy that dissented. It was almost unanimous. I mean, can you imagine everybody at the Fed sitting around this big table? How do we revive the economy? What's the plan? And somebody comes up with, let's create a housing bubble so we can create a bunch of wealth and people will go out and spend it, and we can get people to speculate on real estate prices because they're going up, and all this is going to create jobs in the housing sector. It'll cause more home building or home remodeling. We'll be able to consume more. Somebody came up with that, and then someone else said, great idea. I mean, didn't they see that movie? Don't they know how it ends? Apparently not. You know, I'm going to tell you how that movie is going to end, right? It's going to end in a currency crisis. It's going to end in a sovereign debt crisis. It's going to end in tears and misery. And the amazing thing is, this has happened over and over again throughout history, yet we continue to repeat the same mistakes. We never learn from the past. And I think the problem is, it's the politicians who are making these decisions. Despite the fact that the Fed claims to be independent, it is not. This is all about politics. It's not about economics. It's not about doing what's good for the economy. The only jobs they're concerned about is the jobs of the politicians who are afraid that if the Fed tells the truth and actually does the right thing for the economy, that they might not get reelected. Because the right thing for the economy is bad politics. And even though you can look back in history and see how many times governments have destroyed economies by destroying the currency, they're going to do it again because it's politically expedient. They don't care about history. They don't care about the country. They care about themselves. And so they're doomed to repeat these mistakes because it's the only thing they can do. The Fed can't admit what the problem is. The Fed can't take the punch bowl away. It doesn't want anybody sobering up. It wants to keep force-feeding us alcohol so we don't realize how screwed up the economy is, and maybe we'll reelect the incumbents one more time. All I can say is, you got to look through all the smoke. You got to buy gold, buy silver, get out of dollars. Get out while you can. Get into real things. Own stocks outside the United States in currencies with dividends and income that are not U.S. dollars. This is the most important thing that you can probably do. You got to save yourself first. If we're going to save our country, that's the title of my book that's out now, The Real Crash, America's Coming Bankruptcy, How to Save Yourself and Your Country. You've got to save yourself if you're going to save your country. We're going to go over a real fiscal cliff. We have a real crisis coming because of the Fed, but we've got to protect ourselves. Hopefully, when we have this sovereign debt and currency crisis, when we have this giant shock, that just maybe the Fed will finally, and the government will finally have an epiphany. Have the moment where that light bulb goes off and they realize that, we can't keep doing this. We can't keep repeating these mistakes. There's something more important than the next election, and that's the future of our economy. But until then, don't bet on any political integrity or anybody in Washington doing the right thing. We're going to be heading full steam over the edge of this cliff, blindfold on. So all you could do is buckle up, prepare for the impact, and protect yourself. In fact, one of the craziest things that Ben Bernanke said, of course, he said so many, it's hard to pick which one was the craziest, but he actually said that he believed by printing money and buying bonds, he was actually going to help reduce the deficit. Well, how could he do that? Well, he said that by printing money and buying bonds, we're going to have a stronger economy. And the stronger economy with more jobs is going to help bring down the deficit. Of course, the exact opposite is true. You don't bring down the deficit by monetizing it. You don't bring down the deficit by making it easier for the government to go into debt. You don't stop the government from borrowing by buying up their bonds and making it easy for them. If the Fed were really concerned about bringing down the deficit, it would let interest rates go up. If interest rates went up, the deficit would have to come down because the government can no longer afford to finance it. It's the Federal Reserve, it's the money printing. That's the reason the deficits are running out of control. And the fact that the Fed has just said we're going to have QE indefinitely, we're going to keep interest rates low forever, we're going to print money indefinitely to buy bonds, that just basically gives a green light to the politicians to do nothing about the deficit, to keep on borrowing, to keep on spending, to grow the deficit until it all blows up. Because that's the only thing that's going to stop this. It's going to be an all-out crisis. Hopefully, we get the crisis sooner rather than later. Because unfortunately, the further into the future it hits, the bigger the explosion. That's it for today. Take care, everybody.